Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:36 a.m. Central Time, and I'm recording this in preparation for the market day of September the 16th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in. We did have some rather interesting activity in the overnight, but not in the U.S. markets. The U.S. markets are essentially all scratch. Nothing here in any of the four indices to get any note to, and this is, of course, as of the time of this data cut. Crude oil up 1.5%, euro down about 0.5%, bonds down just marginally, and then gold up about 0.4%. Where the action came from was in China, and my understanding is the last hour of that market just went absolutely bonkers, and it closed up nearly 5%. Hong Kong up 2.4%, Japan up about 0.75%, Germany up a little over 0.5%, United Kingdom up almost a full percent. In terms of macroeconomic reports for today in the United States, you have CPI. There is the housing market index that ETF for the home builders has been doing very well lately, so that could be playing with that in one of the better industry groups of late. Crude oil inventory is today, so if you're a crude oil trader, you need to look out for that. Let's see, you also have late today, long-term purchases comes out. Then tomorrow we have building permits, unemployment claims, the weekly variety, current account, housing starts, Philly Fed manufacturing, and for natural gas traders, the natural gas storage report. The big one, of course, for the entire week is the FOMC economic projection statement and Fed funds rate announcement. And that's then followed by a press conference. So remember, that information can kind of come out in pieces. You'll have the initial burst of energy, and then followed by the press conference, which can, in quotes, clarify. And many times will send the market in some pretty jagged directions as people knee-jerk response to some of those events. So a lot heading into tomorrow. In terms of, let's take a quick look at the charts. Many people were a little surprised just how much movement we had yesterday. People were expecting that we would stay in the triangle that has been much talked about of late. And you see this pattern right here. Well, it clearly closed above the triangle. It is up against some key areas of resistance. You see the moving average line here. This is actually part of the cloud setup, the Ichimoku cloud, if you're familiar with that. But anyhow, whether you're looking at moving average type resistance, you're looking at horizontal resistance, there's a number of things kind of coming into play. You see the flat cloud over here to the right. That certainly represents that there has been in the past, a significant area of resistance in this area, and as a result of that, we're starting to kind of run up against that. At the same time, from a timing perspective, we're running up against the Fed announcement. So it's going to be very interesting. Though I and others that I follow were kind of surprised at the amount of action that came out of yesterday. So be careful of false breakouts. Now, if this truly follows through, we're going to know it. I mean, because there's a lot of room between this area of resistance and the prior range action that we talked about for so many weeks. So if we truly break through this ceiling here, we'll likely run another 45 points, if not significantly more, before we run into the next wall of resistance. Now, if this does prove either to be rejected today, or through the Fed announcement rejected, then likely back to the original hypothesis, and that in testing the prior lows. Now, some people feel like this right here was the capitulation bottom and exhaustion, and that we will now, out of this congestion, break and then come back at least into this prior range. So there's two different theories here. The Fed announcement and the resulting price action from that will probably likely resolve which theory proves out. Russell, of course, had a good day yesterday as well, as did the NASDAQ. NASDAQ also probably the most bullish of the four indices, and a clear close above this prior level of resistance, so that is significant there. And then of course the Dow probably right up against its resistance area. So a number of pretty interesting things that came into play yesterday on the charts. Let's go to our daily report. Let's see, there's not too many changes here from yesterday. We're still IBD status, uptrend under pressure. Accumulation distribution score for the S&P remains a D, the NASDAQ an E. Sell signal with the GMI index, that author remains in cash with a 1 out of 6 score. Primary market condition remains strong, bear. So the consensus here is that your investment posture would be pretty bearish until proven otherwise. There were some changes in the stock charts decision point scoreboard, so we are getting some green arrows across all of the followed indices in the short term. But that was also followed with an article which spoke of these bear or bull traps, in this case a bull trap. And if you took a look at the chart and you associated this mechanical signal with the chart would call into question that these may be bull traps. So you go back to our chart, and what we were just talking about, significant resistance in the area, though like in the case of the NASDAQ, it seemed to be starting to break through. Kind of an interesting inflection point, but to do anything until you have that Fed announcement would be very, very, very aggressive. Intermediate term market posture remains weekly bullish, and we keep going up just ever so slightly. This bull market, if you're going to measure a bull market as in the last 3-4 days, has been just crawling up in terms of this investment intermediate term market posture. S&P though now 36.6, Dow 42.9. I mean, we keep crawling up much more. We're going to go into a full out bull score. NASDAQ's already got a bull score at a 58.4, and the Russell 37.4, still weekly bullish. And the one that in some ways still calls into question this NASDAQ rating, because normally you'd look for these two. We think of them as the cousins, and then these two as the cousins. They usually move very much together, and for the NASDAQ to be the most bullish and the Russell to be so much farther behind, really calls into question whether the institutions are ready to go into growth-oriented, high beta type stocks and really go somewhere with them. So perhaps a warning of kind of a false bull breakout. In terms of overall hedge warning status, remain at level 2, which is our red light. And indeed, we've had a number of these metrics fire off once again. Market in decline has fired off. Sharp increases fired off. This is probably in some ways related to the fact that there's a lot of put protection being bought. There are a lot of very, very worried traders that are hedging in front of this Fed announcement. And so even though you had an increase in the price action yesterday, it was accompanied by a considerable amount of hedging activity. VIX remains above an 18. You have also a volatility ratio warning that fired 2 days ago, came back into the zone yesterday, but that's also a warning. VIX phase has been of late increasing, I would say, is the general trend. And then here's this skew. It's above 135, which you should read that as the chances or probabilities of a multi-standard deviation move are enhanced. Not a prediction that we're going down, not a prediction that we're going down by a certain amount, but that the chances of the multi-standard deviation move are certainly elevated. And it goes very much in line with how we measure this hedge warning status. We talk about increased levels of risk in the market, not necessarily a prediction that the market is going to go down. If indeed, especially with new information, you find that the institutions are willing to buy at current valuations, they can absolutely take it up, and all these warnings mean nothing. So, but on the other side, that there are, through the consensus of these various metrics that we've cobbled together, there is this signal that there is increased risk, and if that risk were to become omnipresent, you could have the circumstances for a very significant down move, is already present, kind of thing. So conditions are ripe. Think of it like a hurricane flag, and the hurricane is known to be out there a couple days away, and the question is it going to turn towards your home, or is it going to turn north and go somewhere else? Those conditions are ripe for things to get decidedly worse in the short term if things were to set up just right. So New York Stock Exchange, new highs, new lows. Very benign yesterday, nothing really coming out of that. Intermarket risk aversion indicators still is all 5 of them risk on, so that certainly was a positive from these various indicators yesterday. In terms of special opinions, we remain with the same 3 opinions, primarily at this point, especially one day out. If you've not already scaled in or done something, you really probably should wait until after tomorrow afternoon to gain that additional information. There are a lot of traders that are debating as to whether the next big wave, is it going to be up 100 points or down 100 points, and a lot of opinions that guess would be about a 50-50 shot. So very difficult to put a lot of capital in place when you will have that information in a very short time, really about 36 hours. You'll have that knowledge, and you'll be able to place these kinds of strategies into your portfolio with that knowledge behind you. In terms of sector specific, there was some improvements yesterday. We've actually got, with transportation and technology in the short and intermediate term, actually turned up. A lot of these have turned neutral, though again caution you, when you look at these lines, a lot of them are really quite flat, and if we get a Fed announcement that takes us negative, you'll see all these sectors go red in a nanosecond. Also, percent change, very good day yesterday. Even utilities at the least sector was up 0.5%, and industrials, financials, healthcare, I mean, many of these well over 1% moves yesterday. So quite a bit of improvement on the short term. Now, obviously, long term, we're still significantly down 1 month, 3 month, and even year to date, or even back to 1 year. A lot of these have got a long way to go before they are setting up for something truly positive. Now, that doesn't mean that you wait until it's green across the board. Obviously, bottoms are made by first 1 day, but you will want to take and pay attention to which sectors are performing not just well for a day, but most consistently day to day, and this is what this particular graph helps us determine. Well, that should be enough for today. If you find what you're getting here is helpful to your trading, we greatly appreciate you retweeting us to your Twitter followers, to your StockTwit followers, liking us on YouTube, subscribing to us on our YouTube channel. Direct email support is at support@falconglobaltraders.com. Your comments and other feedback are most welcome there. More information about what we do can be found at this website. Disclaimers as always. Hit the pause button if you need more time to review the disclaimers. And we'll look forward to seeing you back here tomorrow morning before the market opens with the market preview from Falcon Global. Good trading and goodbye.